Are you ready? Welcome back to Economica. Very glad to be with you today, and Merry Christmas, everyone. I hope you're enjoying your time. Yes, I hope you're having a great holiday and you're preparing to smash it through next year with the great New Year's Eve and celebrations, and hoping for some good times in our world, on our planet, like peace and a bit more of peace and less conflict and less problems. So I'm here with you today with all these very good wishes, and yes, I've been spending my time working through a lot of data, and I have been prompted to have a deep dive study about the UK budget. Why I did this? Yes, I did this because as we can see, there has been a lot of noise about the UK budget. Is it good for growth? Is it bad for growth? There have been tax hikes on employment, or changes in this, changes in that. I will go through everything. I think this will be a very long video. I'll try to explain as much as I can, although I'm not how can I say, my field of study is not fiscal policy, so I took some data and I analyzed the data, I went through the data, and I tried to explain a bit of what is the UK macroeconomic framework, and what could be the potential improvements, and what are the structural weaknesses of the UK economy. And yes, I decided to give you a thorough walkthrough about this topic, because first of all, if we just look around the world, we can see that the United States, last minute before Christmas, they managed to kick the can down the road and agree in Congress for to raise the debt ceiling. So they basically they agreed on some exceptional, like short-term fiscal measures to make sure that the federal governments can keep paying its way through the fiscal purse. So the United States was late. And I can tell you that Italy, they sneaked through the DEF, the fiscal plan for next year, the budget, just in these days between Christmas and New Year's Eve. So nobody is in Parliament. I mean, it's holiday season, and there is not enough time. Not enough working days for parliamentarians in Italy to discuss about the budget for next year and the budget projection. So Italy is late. France, they just about managed to have another prime minister, Hof Barnier in Beirut. We haven't got a clue what is gonna be, and we saw how Barnier was basically brought down by the extreme aisles of the French Assembly for his budget, for his fiscal plan to try and reduce, constrain or narrow down the France fiscal deficit and consolidate France fiscal position, because we know that France has a huge deficit, of 6%. I don't have the exact data though, but we see Germany, they're going for new elections. So all these moaning and doom-mongering and all these problems. And you see, the UK, the British government, it's a matter of fact, they are probably top in class. I don't want to exaggerate, but they brought to the House of Commons the baseline budget in October, so it was before schedule. It was on schedule, but before many other advanced economy, including the United States. The United States, they just temporarily they raised the debt ceiling and they just carry on, kick the can down the road, and it doesn't matter until it matters. You know, fiscal deficit, they don't matter until they matter, and then when they matter, then it's a bit of a problem. Yeah, right. So the Exchequer, they brought forward the budget in October on schedule. The OBR has produced an update in December and in October as well. So they are on time, they are on schedule, they are best in class, I'd say. So I would not complain about that. And if I can say a big shout out to the ONS and the OBR for the amount of data that is available, although with a little disappointment, because the data from the ONS, they are very, very difficult to work through, and to basically that you get straight some time series from the ONS and you work it through. You can create a multivariate econometric model, because I can take one file for GDP, and then it's another file for inflation, and then it's another Excel for, I don't know, unemployment, and then to have it's for the machine, it's very difficult even to work it through Python and then clean the data and then take the data, the clean data, and pull it through the other software. These are all technical stuff. So the ONS is a bit of a mess. Some other Excel sheets I had to transpose, just flip around columns to rows, some very funny stuff. And I'm sharing with you my screen, and these are some nice IRF basically these are VAR charts that have been elaborated by the machine according to the macroeconomic variables that I put through the machine. So today I have a lot to say, and I don't know where to start. So let's start from the data that I have, and then we will walk through, and I'll try to explain what are the structural weaknesses of the UK economy on a broad measure, and then I'll try to provide some fixes or some changes that could eventually improve the overall macroeconomic framework. So, as I said, here we have a VAR, and okay, so the VAR, these charts, they are all the outcome of the VAR data set. So the VAR has been implemented on 19 variables, and it has been divided in subsets of variables, because a VAR cannot handle at least the software that I'm using, it can't handle 19 variables at once, because the matrices are huge and the calculation, they are difficult. I think some other softwares may be more professional, those that are available at I don't know, financial institutions or like research think tanks or stuff like that. They may handle such large amount of variables at once. But anyway, so what are the variables? The variables that I chose have been, so I also have a forecast from an ARIMA. So I took the Bank of England interest rate, real GDP, monthly unemployment, monthly employment, the average cost of borrowing for the government. Also that the GDP is not good because, so it's 18 variables, because there are too few observations, just a little bit more of 50, and it doesn't align with the other. Then I had CPI, private consumption expenditure in aggregate, and the government consumption expenditure in aggregate, and then core CPI, so core inflation, and house prices on a broader scale, and gross fixed capital formations. These are an indicator for investments in the economy. Retail sales and total expenditures is an aggregate of private and public expenditure, and then the M4, so the M4 money supply aggregate, the stock of money, how it grows or it changes on a percentage quarter on quarter, the net public sector debt, gross national income, GVA is gross value added, which is very important. But these are all different different methods to measure the same thing, like gross national income and gross value added. There are two methods to measure what is basically the economic output, or the gross domestic product. Then the percentage change of the assets for insurance and pension funds, and implied GDP deflator. GDP deflator, it's necessary to measure real GDP. Okay, so let's start with var data and see what the equation gave me. So the result equation for the this strange name soya latte, it's Bank of England bank rate, which is 4.75%, the latest Bank of England meeting. And you can, if you're lucky, you can check out my other video, and I was saying that inflation came up higher, the latest data in the UK, and so the Bank of England was not in a good position to cut interest rates. So it actually was true what I was saying, and they kept the interest rate steady, and they said, okay, we'll take stock of the data, we'll come back next year and we'll try to figure out what to do. So with the other incoming data from of Q1, the first quarter of 2025, so they start to have a macroeconomic framework to work for next year. So okay, let's see if we have so this is relevant data, this won't count. Can do it quickly. Okay, so interest rate, nothing to be worried about. So results from real GDP. Okay, real gross domestic product is the same. Okay, this is unemployment rate, too small, but there is some impulse response function between real GDP and the unemployment rate. And we have here, lag 2, so 2 quarters before, if we have an impulse in the impulse response function for the interest rate equation, then from inflation, so if we see that inflation probably slowly goes down, this can then generate a response function with 2 quarters lag for interest rate. Okay, so let's say 6 months ago, Bank of England saw that the rate of inflation was decreasing and converging towards 2%, so they decided, okay, we can cut interest rate. Okay, so here, yeah, okay. Lag 4, real gross domestic product, we have a negative coefficient, right? Okay, so this is very interesting and it is very funny for me. Okay, so if 4 quarters before, so let's say between the end of 2023 and the beginning of 2024, we have an impulse from real GDP. So real GDP in the UK between I think 2023 was a very flat year, even also Q4 was negative growth. So the negative coefficient, it leads me to presume or to think that if we have a negative shock from real GDP 4 quarters before, yeah, so in Q4 2023, then with 4 quarters lag, so 1 year later, the Bank of England decides to cut interest rate. This is not, I mean, it is in simple terms. So you have, it's like a function, you know, you have two ingredients. So if I have an input from the starting ingredient, what is the response from the other the other factor? Okay, so if I have an impulse on a set A, what is the outcome on the set B? Okay, and then in between there is the function that takes the input from A and then as an output in B, right? But consider it A and B as a set of data, okay? Set of numbers, set of data, etc. But what I want to I would love you to understand is that at the beginning of 2024 and at the end of 2023, we have a negative input from real GDP. So if we have stagnation in the UK economy, then you would say, okay, the Bank of England right now needs to cut interest rates. But what happens is that the Bank of England was holding steady interest rate. Why? Because even lag 2, it's 6 months ago, 2 quarters ago, so 6 months ago, we have an impulse from CPI, from inflation, right? So basically, let's say that at beginning of 2024 and in Q4 at the end of 2023 we have negative real GDP, okay? But the Bank of England couldn't have a very strong monetary policy stance. Why? Because inflation was still high, and then we have confirmation of inflation going down in the middle of 2024. And so this factor, this input also works through the data, to the response function, what is the results or equation, the resulting equation of interest rate. And then you see that slowly the Bank of England can cut interest rate. But still the Bank of England went from 5.25, 5.5% to 4.75. So in total, maybe they've done a couple of interest rate cuts. Now I don't remember exactly, but I like to explain here in as good as I can how macroeconomic variables in the economy, they work with a lag, and even if there was negative real GDP at the end of 2023 and at the beginning of 2024, like 4 quarters ago, then you have to wait another 2 quarters for inflation to tell you, okay, inflation is going down very steadily, and we can have a more robust decision to cut interest rate, because more data go into the right direction and validate the empirical assumption that the central bank can cut interest rate. These are not problems, these are the features or the characteristic of stagnation or stagflation, right? We have negative GDP and high inflation, so you have stagflation, and it's people, you see, it's the worst of both worlds. So the central banks cannot cut interest rate, but you have negative economic output, shrinking economic output, and still you have high inflation. So it's a very not easy situation. So let's go forward. So what happens with the unemployment rate? And yes, okay, so if one lag before, in the previous quarter we have a coefficient change in interest rate, then we have a response function for from the unemployment. So the transmission mechanism between interest rate and the unemployment rate, it's quite it doesn't take long. It's for example here, it tells me there is 1 quarter lag. If I change interest rate, if I decrease interest rate, or I keep interest rate steady, or change interest rate, I decrease interest rate, then I have a decrease in I don't know, then I have response function in unemployment. And then, I mean, if I'm decreasing interest rate, it's probably because unemployment is higher, so I want to relieve pressure in the economy, and I want to soften the cost of borrowing so that business can invest and hire and create employment. So these are mechanisms in the economy. So response function, it's the unemployment rate. Let's see what we find here. Same variable, so the unemployment rate as a auto it's correlated on itself. Like if I have a change of unemployment 2 quarters before, this will fit through with 2 quarter lags. No, sorry. No, this is the coefficient. I'm sorry, I took the wrong column. I apologize. Okay, yeah, it's the column in the middle. So okay, I don't see anything relevant here apart from okay, it's not very easy. I think we have here lag 4. So if I have an impulse from the CPI from inflation 4 quarters before, this will likely generate a response function in monthly unemployment rate. And this is probably classic Phillips curve economics. So that's, in broader terms, inflation and unemployment, they are inversely correlated. So when there is low unemployment, so a lot of people are working, they have a job and they have an income, normally there should be higher inflation. So low unemployment, higher inflation, because there is more aggregate demand in the economy. If there is higher unemployment, so there should be lower inflation. Why? Because with less people working, there is less aggregate demand in the economy, so inflation or prices tend to decrease, because people are unemployed, they don't have money to spend, so there is less demand for goods and services, so businesses, they start to decrease their retail prices, so to make it more affordable for spending. So let's go forward and see exactly what happens with consumer price index. And so consumer price index, with 1 quarter, it has a feed-through pass-through effect on the same variable. And CPI, okay, I don't know if it's probably the same. I don't know if, well, maybe I took the wrong table, but let's go forward and see if we find this is private final consumption expenditure. I don't find anything very interesting here, so it probably this model needs to be adjusted and refined, probably because I didn't work through with first difference. But anyway, we can see here that if 4 quarters before we have a means less retail sales, and GVA is the same. Okay, it has, so this is a large it's larger than 5%, but you just take it as an example. So if we with 2 quarters before we have a negative coefficient change for the level of employment, then we can have a, a, an output response effect on retail sales. So less people employed, there is less people that go out and spend. And yes, 3 quarters lag 3, same as the same variable, which is gross value added. So here we have a positive coefficient, so positive gross value added, and yeah, gross value added, and the employment rate, they are all relevant with 4 lags, so it's 4 quarters before. So if we have negative gross value added, 4 quarters lag, and negative employment, this will have a response effect on retail sales. So let's see what happens with the M4 money supply, the stock of money supply, if there's anything relevant. No, nothing to read. And yeah, this is the equation of results equation from gross value added. We see that there is a parameter here which is relevant. Oh, I found 2 parameters, which is interesting. So third lag, so 3 quarters before, if we have a change in M4, the aggregate stock of M4 money supply, and we have negative growth in money supply for some reason, then this will have a response function from gross value added. So if we have less money supply, then we'll have a response function of gross value added, which probably would be a negative coefficient. So if we have 4 quarters before a positive coefficient change for retail sales coefficient, then with 4 quarters before, retail sales has response function for gross value added, and then yeah, we see gross value added here is the same variable. And yeah, last but not least, employment levels. Okay, so one lag, if we have a negative coefficient with 1 lag before, 1 quarter before from retail sales, this as a response function from employment levels, right? So if we have negative retail sales for 1 quarter, Well, I should not say that, because I didn't put through the correct data. So this doesn't factor in the increase in national insurance for employer. But let's say that the rate of employer national insurance starts, it's higher next year. So we have a 0.1 effect on CPI, yeah, 0.2 effect, higher inflation, but at the same time we can have higher unemployment, because it's higher the cost to hire so to employ people, citizens, and so we will have higher inflation, higher unemployment. But I specify again, in this graph, the variable of national insurance contribution, it's not working in the data. So this is just an assumption, but I want to explain in the real world what could be the scenario. So we see that here consumer price index, it will chop and change, and it will have response function which is similar to real GDP, and we know that real GDP is discounted by inflation, so this goes up and down by the same measure, so it's +1, -1, so it neutralizes itself. So now reverse, if we have a 0.2 unit change in interest rate, we will have a change in consumer price, and this basically will feed through and will converge in after the 6th period forward to the baseline scenario. So we can envisage that the Bank of England decides to cut interest rate in between 0 and 4 months next year, then in the next 4 quarters, assuming that these are quarters and not months, then we will have also a follow-through effect of CPI. It means that Bank of England is cutting interest rate because CPI is declining with interest rate, but then we see that it follows through and converges to the baseline scenario. It will have also a negative change in inflation. So these are all projections. So at the beginning we have minus 0.3 unit change in interest rate, and we will have also a response function from unemployment that will be negative. So I don't know, maybe declining unemployment or rising unemployment. This is very interesting. I'm learning how to read these charts, but it basically, the response function says it's very simple. I have a negative minus 0.3 unit change in interest rate, and then this will lead to an equal response function from a negative unemployment rate. So theoretically unemployment should decline as well, should be lower unemployment. And these are the charts for this is the chart for interest rate and real gross domestic product, but we see that it moves in a range 0.1 minus 0.1, so it doesn't have a direction, a trend direction. Then okay, so if I have a negative change in unemployment, this will produce a negative change in consumer price index, which is counterintuitive in Phillips curve dynamics, but then we see that after we have a rising consumer price index. And then also here, yes, here, yeah, interest rate, unemployment, interest rate. So if we have a decline in unemployment, interest rate would follow through, continue to cut interest rate, then it will converge to the baseline scenario. Gross domestic product, it varies a lot. There is a lot of variance here, but also here negative 0.2 unit shock in unemployment rate, and then we have a follow-through of real GDP, and then in between the 5th and the 6th period forward we have a 0.2 positive shock too, and then we have converging to the baseline scenario. And then okay, this is real GDP. Real GDP, if we have a change of minus 0.2 unit going from 0.3 to 0.1, so a decline in real GDP in the first 2 months, let's say, or 2 quarters, which is not the same, but I'm trying to go along with the chart. And then this will produce a negative change in inflation, which makes sense. So if there is less economic growth, this means that also tendentially inflation prices tend to go down because there is less demand in the economy. And in the following periods we have a pick up of inflation of real GDP, and then we have a sudden very large shock in real GDP going from 0.2 to minus 0.2 units to 5, sorry. So this is this is a large change in large shock in real GDP that will then generate also a large shock in inflation, from positive to negative minus 0.2 unit change in real GDP and inflation. So here we have negative GDP for the first part of the year, first 2 months or 2 quarters, and then it follows through. So negative GDP, probably we will see that the Bank of England will cut interest rate, also because here we have an initial negative shock of real GDP and a decrease in inflation. This could be a macroeconomic picture, right? So then you see a normalization of real GDP, just trending here, less than 0.1 unit, so this is a very small stabilization. Same for interest rate. So yes, a negative impulse from real GDP 2 and 4 periods forward. So basically this VAR model is telling me that, unfortunately, it's a machine output, so we'll have to see in the real world, but the output of machine with doing the VAR model with 4 lags, the output is that for next year, the first 2 quarters, hopefully only the first 2 quarters, there will be a negative change in real GDP by more than negative 0.3 units, real GDP. This will have a negative change on unemployment, I don't know. This would mean that unemployment is decreasing, but it could be also that unemployment in this sense is rising, because there would be negative economic growth, a negative economic output, and then we see that slowly it turns up. Okay, and it converges to the baseline scenario after 4 to 6 months. And then this is core CPI, which it neutralizes itself. Core CPI and fixed investments, also it's narrow trend, core CPI. which leads me to believe or to think that core CPI will be quite sticky to the levels that is now, around 4%. And then let's see if we found, okay, so you see that, for example, private consumption expenditure, what will be the response function of core CPI. So we see that private consumption should be stable at the beginning of the year, but if we have let's take a scenario where real GDP is declining, then we have a pass-through effect on private consumption in the following periods. So if we have recession or a negative economic output and rising unemployment, we see that then with 2 to 4 periods forward, then private consumption tends to follow through the negative real GDP, and so does core CPI, so declining core inflation. So this is trending, but we see a declining private consumption in the first 4 periods, which follows through with a negative shock, 0.8 unit positive private consumption that comes from Christmas season. People spend a lot, and then you have a sharp decline in the first 4 months next year. This is a -1, maybe more than 1, -1.1 or 1.05 unit shock. And then it follows through. Also, the government spends less in the first 2 to 4 months. This is larger. This is -1.5. Overall, in total, it's -1.5, more or less. So here, 0.8 and minus. Oh dear. No, -1.3. Sorry if my algebra is crap, but overall, if we sum up everything, we go from 0.8 to 0, and then we add another negative -0.5, so it's -1.3. I apologize if the algebra is not correct, but it's a large shock of negative private consumption that feeds through the government consumption, and this is consistent with the scenario of declining real GDP, declining gross domestic product. Okay, so we saw here this one, and then private consumption and then investment. So we have same declining private consumption, and we have just a narrow range of investment, private investment. So employment levels, these are narrow ranges. I don't want to spend time on this. Gross value added, we have an increasing gross value added, but then immediately after the second month or the second period forward, then we have a decline in gross value added and a subsequent decline in employment rate. So I want to say, contrary to what should be intuitively the interpretation here, is that if we have a negative -0.3 real GDP shock, it's not the unemployment rate as a negative. The negative effect on unemployment rate is that unemployment rate goes up. Okay, so this var is painting me a negative economic growth scenario, which I don't like this stuff. I mean, but I go through the data and I have to take stock of the data. I have to read the data and understand what the economic forecast is and how this basically it's important for a baseline scenario when you are constructing fiscal policy. So negative change in gross value added, and then we have a decline of the level of employment. And all these charts, I repeat, these are not factoring in all the tax changes and everything, because I don't have these variables. No, I haven't even created the dummy variable or anything. So these are all just what you see here. This is the data, this is the other data, so all the tax changes, they are not accounted for. Right, gross value, so negative minus supply, so negative employment, and then see that minus supply just as a positive balancing, but also declines. So yeah, we have subdue money supply here, and then a slightly increasing money supply of 0.2 unit, and this creates gross value added. And then we have a converging to the baseline scenario. And okay, so for the next year, let's say retail sales, this is also significant for me. Not for me, I mean to is consistent to the scenario that the VAR outcome is produced. So we have retail sales, they start from a high level, Christmas effect, and then we have a negative change of a bit more than minus 0.3 unit change in retail sales, and this basically generates a response from also the employment. Level of employment should decline because there is less retail sales, so I need less staff in shop, I'm gonna hire less people, right? So yeah, declining retail sales, which will be in a range, also will have a negative shock for gross value added. And yeah, that's it. So right, back with you, and yes, so these are the VAR outcomes, and which I don't know, I mean I'm not sure at all, but let's go through the ARIMA forecast quickly. Oh, there's my cat with me, I don't know if you can hear it. So the ARIMA forecast, it's we see here the ARIMA optimized model for the CPI, and here we have the differentiated CPI first difference data, and it's very easy to see here we have a 0, so this is D, so there is no need to do the first difference of the data. Okay, so we see that CPI, the ARIMA model tells me that it would be going up in the next 4 to 8 quarters, and this we have a first difference positive changes here, and then we have some variance. Yeah, this is the same chart. Let's go. Core CPI will be stable. This is the outcome of the ARIMA forecast, and this also is the first difference data of core CPI, and it will be stable. Okay, let's see. Okay, the level of employment rate will be consistent, will be here. Very, it's not precise, but will be a little bit more Okay, private final consumption. Okay, so let's go forward and take some other data which are from the OBR. And here we go, we start to go inside the nitty-gritty of the fiscal policy, and I'll try to say a few things, and forgive me if I'm not correct, but okay, what we should observe is we need to see, for example, is if the government it runs deficit or a surplus. So we see that although here there is not a minus of the government. And so the government is able not to run a deficit but to run a surplus, because here we see that current budget deficit is negative, so it means it is a surplus. They were having surpluses every year up to 1973. So the energy sector in an overall economy, it's an important factor, and it determines basically the cost of energy. It fits through inflation, and inflation fits through the yield curve, the term premium of the yield curve. So if you inflate the economy, if you kick the can down the road and you keep inflating away the economy because you believe that inflating away the economy basically it lowers the cost of debt, because the government pays back the debt with the depreciated currency, then this is not always the case, because then the cost of borrowing goes up, because higher structural having an economy which has a structural higher inflation above 2%, let's say, which is not the old rate, but it has structural higher inflation. This means that there are structural higher costs, like energy costs, and then the borrowing cost is higher, and then the primary balance, as we see here, it's negative. But before 1973, let's say, the primary balance was positive in percentage terms here, and the budget deficit was a surplus. Okay, so you see that after 1973, the primary balance it was negative during the 1970s, and then it briefly turned positive in the 1980s. Okay, and yes, because there was a very large the primary balance was positive, slightly positive, but if we see here the aggregate picture for the fiscal policy, still there was a budget deficit, so yeah. And I'll try and pull up the UK sovereign debt 1 second. So yes, what is important for fiscal policy is inflation. So if there are different theories for how to adjust the budget. So there are, I think, modern monetarism, it believes that inflating away the debt, then basically it reduces the cost of paying down the debt in future, and it generates economic growth. But this is not, it doesn't always work well, because when you inflate the economy and you have a lot of money supply, which is not in line with the actual aggregate supply capacity of the economy or the potential output, but you have more money supply than what is the estimated potential output in aggregate on the economy, then you start to inflate assets and you inflate prices, and then this becomes a higher yield curve, so higher cost of borrowing. So it doesn't work very much. So what works is fiscal consolidation. So when you have a primary balance that it's positive and you are able to generate fiscal surpluses, this is what is good. And this was the 1950s, 1960s, the 1970s, and then on top of the structural feature of a budget, then there are the cyclical factors. So what happens is that if an economy, the private sector, goes into recession, you want to have some stabilizers, then some cyclical adjustments that will allow you to basically create economic growth, for example by lowering taxes or doing some investment in aggregate supply, or basically if the economy is in a good shape and you have a strong economic growth, then that is the moment in time when you can increase taxes and then you can take some more revenues because the economy is strong, so I can ask more tax because disposable income has grown above the rate of inflation. Those are the cyclical factors that are adjusted in a fiscal position. And on the basis of the structural factors and on the cyclical factors, then you have a baseline scenario. So when we hear on the telly that there has been a budget, and that is the baseline scenario. So we have a baseline scenario of 2% growth next year, and then 1.8 and 1.6. The baseline scenario it's 4% core inflation, etc. And I want to have a 2.5% public deficit that is allocated to investment. Those are baseline scenarios. Then what kicks in are the cyclical factors. So basically it's the human interaction in the whole economy, the private sector, the public sector, and also the exogenous factor, which are the economic inputs that come from outside, like the imports that an economy takes, the exports, how the prices vary, if the energy prices are higher or lower. So all this variety of things, they feed through, and then they basically they may not align with what is the baseline scenario, which is basically the budget projection. Say, I have a budget, this is my fiscal policy, this is my baseline scenario, I will do this and that, and then the baseline scenario is we will have this kind of economic growth, this percentage of inflation, etc. But there are cyclical factors that work on top of the structural factors, and this may change in the economy because there is the private sector that works through what are the fiscal policy decision, and then it adjusts, and then in the real world, then the ordinary person and the policymaker, they see what are the outcomes. And then the OBR, it's very nice because it provides a forecast for up to 2029, 2030, and yes, so the government basically argues that between 2027 and 2028 they will be able to generate a surplus of 0.3% in the budget, and which it isn't very consistent with the projected level of debt, because we see that debt to GDP, it will go from 99% to 103%, 104, 105, 106. So it will be so small of a budget surplus that it won't just decrease substantially the debt to GDP ratio. So there are I'm here not to. I'm just going through the data, and I find it very interesting. So, at first glance, we see that the OBR has the historical data, and it does very accurate, just much better forecast than what I did with my ARIMA or VAR models and things like that. And they provide the actual data, and we see, for example, that the percentage of 36.4% will be the amount of taxes that will be implied on the overall gross domestic product, on the GNI. So it's quite a large percentage, and we see that in good economic period in the 1960s, the government as overall share of GDP was taking 28, 29, 30% as a tax level in the overall economy. Now it's at 36%, and it's projected to grow to 38%. So the more is the burden of taxes on the overall size of the economy, then there is less disposable income, but this is proportionate to the growth of nominal GDP, because nominal GDP is 2.8 trillion, 2.9 trillion. So as the aggregate monetary base grows, 3.2, 3.3, the value, the nominal gross domestic product, so the overall amount of taxes as a percentage of the GDP, it grows proportionally. So what else? So I went and I tried to search through other data, and I found these very nice tables. So what I'm trying to say here is that all the moaning and the complaining about the scarce economic performances of the UK, they derive from structural features. One structural feature is the budget deficit. So if you consistently run a fiscal deficit, then this will become a feature of the borrowing cost, and also it becomes a feature of inflation. And also if you have higher inflation and then you have higher borrowing costs, this can be sort of a disincentive for private sector. You have a crowding out of private sector investments because the government or the states wants to take a larger share of investment in the economy, so the private sector is crowded out. There are lots of moving parts to consider, and as we saw before, for the UK, for example, we had a primary balance surplus during the 60s and 70s up to 1973 because energy prices were contained. After we had this century oil shock, energy prices have begun to go higher. The cost of crude oil per barrel has increased from was $3, $10, today it's $60, $70, $80 per barrel. So it has increased 10, 20 folds, even more. And then also we have a change in the overall Bretton Woods pictures, because the dollar is completely floating. We have free floating currencies, and so there is this structural feature, energy, and the energy component. So if I am self-sufficient in energy, if I produce a lot of energy and I'm less reliant or less exposed to the energy market inflation, then this is a good thing for also the fiscal policy. Okay, let's try to see. Okay, we see, for example, that in a brief period between 1999 and 2001-2002, the Labour government, the Blair government, was able to generate a budget surplus. But then there have been budget deficits, and also Brexit. It hasn't changed, it hasn't improved the thing. We have persistent primary balance that is negative. And so Brexit, it does not solve the problem. It has created a lot more problems, because Brexit, it's another factor, another layer that is added on top of what are structural feature of budget deficit, and it's the balance of payment, and it's the structural feature of inflation. I want you all, if you follow me through for the past hour or so in this video, to focus on inflation, because the main issue that we have here in our economies is that we have structural higher inflation, because policymakers, they decided to inflate away debt, and this is a bad example from the United States. And the United States, sooner or later, will have to deal with its own twin deficit, which is a huge fiscal deficit, structural fiscal deficit. We don't know what is structural fiscal deficit and what is a cyclical adjustment in the United States, because the economy was booming, and then they decided to do some sort of cyclical adjustment and to add more fiscal spending, because they decided to do investment in microchips and green economy. All good. The GDP has gone wonderfully, very well. The American economy has grown, but also the size of public debt has grown, the size of debt to GDP has grown. So unless you have a fiscal framework in how to consolidate the fiscal position without inflating, but by having surpluses or consolidating a fiscal position, or having GDP growth which is sustainable, then I find it very difficult. And it's as I said, the UK has like for like as the US economy, or also for example maybe France or other countries in the world, maybe Australia, I don't know. I mean, I'll need to check to have to see the data, to have the exact details, but there is a twin deficit. So the UK has a balance of payment deficit, so it imports more goods than it exports, and it has a structural fiscal deficit. So these are two structural features that they are a problem for the fiscal position, and they are also a drag on economic performance or economic growth, because if I have to ask for more products from outside my aggregate supply in the economy, then I will be basically vulnerable to price shocks, so to market prices. And then this fits into the issue of structural inflation. And that's why I say that Brexit, it has not helped the UK, but it has created more problems, because you have a higher cost of imports, and the balance of payment has not improved, it has deteriorated. So you have higher structural inflation, and with that factor you have another factor, which is currency depreciation. And in the 1970s, in the 1960s, the exchange rate between pound and dollar was £2 per dollar, maybe $2 per pound, or $2.50 per pound. So the pound was worth twice a dollar or even more than twice a dollar in the 1960s or in the 1970s. Now the pound is worth much less. It's worth $1 less. The exchange rate today, it's 1.25, 26. So this basically fits through the structural feature of inflation in the economy. Because if you have a currency that is constantly depreciating, then this will make more expensive to have imports. to acquire products, raw materials, semi-manufacturing products, to have basically to make it work for the industrial sector, or the manufacturing sector, the services sector, etc., etc., etc. So the inputs are more expensive because your currency is depreciated, and there are uh, additional costs, customs clearance, and the time of processing for goods going in and out of the border, it's longer, and these adds to costs, storage costs, refrigeration costs, whatever. And these are all factors that lead to higher inflation. Higher inflation is bad for fiscal policy, and it's bad for the economy in aggregate. And it's bad for borrowing costs. And this means that then the cost of servicing the debt is higher because there is higher inflation. So Brexit has not helped, it has created more problems, because now you have a currency, the pound it's weaker than it was 20, 30 years ago, or before 2016. So these structural features and cyclical features, but it's more structural features that then are the determinant factor of how an economy performs, and what are basically the ambition of the prospect of businesses, and what are the incentives of private businesses to invest. If I have higher inflation, higher costs, and higher borrowing costs, then I'm not incentivized to invest into that economic framework, because it's not going to be profitable. Who does business without profit? So these are the official data on the ONS, and we see summary of balance of payment. So let's go and see line row 32 that the current balance as percentage of GDP in aggregate is negative, it's minus 2.2, minus 2%, and it has been negative all the way since after 2016. So it's been larger, very large, minus 5, minus 4. This is 2023, 22, 1, 20, 19, 18, 17, 16. So we see that 2016 we have a huge negative. 2016, huge minus 5.4% in the percentage of balance of payment on GDP. So there is a negative shock, because if you have the pound, it goes from 1.5 against the dollar to 1.1. You have so large shock in the currency, so large magnitude shock, that it makes your imports much more expensive, and then the balance of payment it goes deep into the red. And this is a structural feature that creates drags and headwinds for the economy, because imports are more expensive and your currency is lower and the borrowing cost is higher. So here these columns are divided by sectors, or secondary income or primary balance, and yeah, roughly around here. of the balance of payment, so importing goods and services, and then on as a percentage of GDP was positive. So we don't have a negative balance, but we have a positive balance. So this means that the overall economy was gaining, was exporting more than was importing. So it was gaining revenue from abroad, which is better than borrowing from outside, because if you inflate the economy and you have negative balance of payment, negative fiscal deficit, it means that you have to ask for investors, outside investors, to lend you money. So you inflate your domestic economy, but you are dependent on outside investors, on money inflows. And this is a difficult position for any country, for any economy. Like the United States is heavily reliant on Chinese sovereign debt investors, on Japanese sovereign debt investors, on the UK, on European. So it's true that the economy in the United States grows, but they are reliant on investors to buy treasury, and this then becomes a problem because you have higher inflation, and the more debt accumulates and you don't have fiscal consolidation, then the structural cost of borrowing it's higher, and it's 4%, then it's 4.5, then it's 5, until it's unsustainable. And then fiscal deficit don't matter until they matter, because the cost of servicing your debt is so large that you'll have to cut all spending. You cannot invest in public services because you're out of balance, you're out of skew. But here we see that after 2016 we have a negative impact of currency depreciation, but before 2016 the primary balance ratio, the primary income ratio as a percentage of GDP on the basis of the balance of payment, so import and export, was positive because the UK was an attractive place for financial services, and this produced net income. After 2016, all financial services have gone, and this basically creates another structural feature, hopefully only a cyclical feature that will be changed in the future, which is a deficit, which is the deficitarian for the UK economy, and this will not be there are not the basis, there are not the foundation for having good economic performances, because the service sector is not competitive, imports they are more expensive, then your exports they are not competitive, your currency is depreciated, so the imports are more expensive, borrowing costs are higher, you have now larger structural fiscal deficit, now persistent fiscal deficit. And then what happens that in desperation, because all the macroeconomic variables they are skewed against the private sector, because they are basically there is a wall that makes completely uncompetitive goods and services that are produced in the UK in the global market, let alone Europe. Forget about that the currency has gone down. That is not true, because we saw in the data that in the 1970s the primary account was positive and the pound was twice worth the dollar. So because the UK is reliant on imports, it needs a stronger currency, because a stronger currency makes cheaper your imports. So the price of your goods it's more competitive in the final output, in the end output, the end product, then you then go and sell in the market. The price is more competitive because when you have a stronger currency, you are able to absorb a lot the cost of importing stuff, okay? So if you have a larger power in purchasing power in the exchange rate, when you import stuff for you, it's cheaper than produce it at home, let's say. So when you have when you have the final manufacturing good or service, then you can sell it at a very you are competitive in global markets. So also this chimera that the panacea of all problems in the UK is that the pound needs to go down. No, it's wrong. And you've seen it year after year after year in the life of peoples and the economy that doesn't work, and it's in the data. So the data, it's hard facts, it's concrete facts. You cannot say contrary to the data because it's lying in front of reality. That after 2016, the currency has depreciated. You have higher structural inflation, but before 2016, for example, between 2000 and 2005, the balance of payment was positive because your goods and services were competitive. So in that time, the UK was an important player in the European Union, and I think that Blair was probably they had I don't know, they had an important role in the European Union, European Commission, I don't know, but they had a decisional position. But now you are completely outside, and you shut yourself out of the market, and then this has a ripple through effects in the global markets. But this is not my opinion, but these are the data. And let's go and check another thing. Okay, financial balance sheet, non-financial corporation. No, this is not what I was looking for. It's definitely not what I'm looking for. Primary income, seasonally adjusted. I have a lot of tables. I went through a lot of data, and some stuff I cannot show you because it's huge. All right, I cannot show you some other stuff because it's huge, but okay. So flow of funds. So how the flow of funds in insurance and pension funds, standardized guarantee scheme. This is an ONS official table. Now, if at the ONS they make up the data, it's not my problem, but I take it as good, right? So here, the balance sheet assets for insurance, corporation, and pension funds. So the balance sheet, the asset side for insurance and pension funds, it was growing up to 2017. Guess what? And right after 2016, the overall balance assets was 1.2 trillion pound. Now it's 200 billion. So you have seen a trillion that it's gone. Right, fairy dust. It's never landed, had never been there. Just a trillion went out the country right after 2016. And this is because services, financial services in the UK, they are not competitive. They don't have full access. And you have other players coming up, like Euronext, Amsterdam, and New York, which is huge, Singapore, whatever. Singapore is in Asia. And so these are money, 1 trillion, it's gone, right? It's not on the asset side anymore, and you're poorer. So that means that pension funds and corporations, they moved out 1 trillion from the asset side. And then you end up with probably negative ratios. But, I mean, when I saw this thing, it struck me because there are real data that explain why there are structural features in the economy that it won't make the economy work well or work at all, because everything is skewed against the private sector. There are structural higher costs, financial sector it's less competitive or less attractive than before, the currency is depreciated, so there are no incentives for outside investors to create businesses and then to create employment. And that's why the ultimate reason why then the government has to expand the fiscal policy and say, okay, we will invest 3% of GDP on public investment, because there is no entrepreneur that does that investment. So what the UK has achieved after 2016? Nothing at all. The overall condition have worsened, because now the ball it's all in the camp of government spend. The government has to do everything. The government has to pay welfare, the government has to pay wages, the government has to do investments, and this will make the debt to GDP ratio higher and will make structural inflation higher, borrowing costs more expensive. It's not good. It's not a good place to be. It doesn't help the private sector, this framework, especially after 2016 and with many other problems that have been created after 2016, like we live now with a war in Ukraine and all the disasters. So these are the real factors, and I mean, I cannot basically hide myself behind the moon with 2 chunks of bacon on my eyes and say, okay, no, these are the facts. 2016, 1.2 trillion in assets, 220 billion, sorry. So 1 trillion, it's gone, right? So don't please tell me that 2016 was the best thing in the world that could happen to the British people, and all the people that said, oh yeah, just do this thing that they did the propaganda and say, okay, vote for Brexit. It's bad. It's in the data, and people should not lie, okay, because they want to be millionaires, and then all the plebe and the servants, the people, the population has to be poor. Okay, this was very bad decision. And another thing, this is complicated stuff. This is economics. I don't think it's right, or I think it's not right to ask ordinary people to vote about so huge thing, because they don't have the knowledge. Okay, I don't want to disregard or demise, but you need to have a lot of data. They don't have the knowledge. They don't know the facts about what goes in. Who on earth works? I don't know. He's a bus driver and he can be preoccupied with what is the primary balance of the exchequer. Who keeps a damn, right? So why silly politicians, they do things, they are voted in, they do a law, they want to take a decision, and then they go back to the people and say, okay, what should we do? So why we voted for you in the first place then? If you ask me for a vote and I send you to the parliament, and then you have to take the decision, and then you don't know which decision to take, why I voted for you? What's the point if you cannot take decision? Is that the basic of your work, right? So why, I don't know, the pharmacist of the cook, the waiter, or the plumber, how they would be aware of the primary balance in the 1960s or the 1970s, and what is the fiscal position of the exchequer, how you are exposed to currency fluctuation, currency depreciation, and you have a balance of payment deficit, a twin deficit that hinges on the economy, and then the currency devaluates and you raise barriers for imports and export, you make the life of everybody else a nightmare. And then you are surprised, and then you come out and say, no, nothing works. Hey, keine Wunder. So, you know, I'm ranting and I'm becoming incandescent as a volcano, right? So I think I'll go through some stuff like tax brackets and kind suggestions, right? I'm nobody, I'm the last person in the Milky Way, but it's free speech, and I want to explain to ordinary people that stuff is difficult. It's very difficult, and if you don't have the material knowledge of doing things, right, you should not be taking a decision which is a wrong decision for your life, right? Before you want to have an informed decision about everything you do, okay? So if you ask to millions of people to decide about a macroeconomic framework without them knowing anything, so it's the most stupid thing to do. Yeah, and it's the most, I don't know what to say. I mean, I hope that it's clear why there are structural factors in the UK economy, and after 2016 these factors have worsened because of stupid decisions. So, tax changes in the UK, what happens? What I've noticed is that the income tax system, no, this is a national insurance, tax rate, sorry if I'm taking a break now. Okay, so what is that? The tax rate, the UK doesn't work with many steps. Okay, what I noticed is that the income tax system in the UK is not really progressive. In what sense? You see that the basic rate from 1 to £37,700, the base rate 20%, let's say, and then between £37,701 up to £125,000 is 40%. So in the middle and in between things there are lots of brackets of income. Yeah, people who are self-employed or they have their own business, so the income is variable according to the cyclicality of the economy, and so to have this narrow range of things, it's not helpful to have a clear, because on top of that there is the allowance up to £12,000 and that's it, you don't pay tax. So I think that the tax system should be made more progressive and have here 40% between 37,000 and 125,000. There should be like a 30% tax rate from 37,000 to 50,000, for example. I'm just making some examples. There should be more steps, gradual steps. And then another thing is that the tax rate should be indexed to inflation, so not to have a fiscal drag. Then if wages, year salaries or wages grow with inflation, then in the end there is a fiscal drag, but the tax revenue discounted for inflation, it's still the same. So you need to move tax bands, income brackets according to inflation. This should be another thing. And then the additional rate of tax, it's just so, I don't know, this is a very raw thing. And yeah, I went and I checked out also the what are the changes in national insurance, that it will go from 13.8% to 15% for all employer contribution to employees. So there are other things that on the tax chapter could be improved for raising more revenues, like removing the exemption for capital gain tax, or removing some exemption for example, if you I think there is a, when you dispose of an asset and then you have a capital gain from disposing of this asset, and then you have 1 year or 2 years before the fiscal year, you say, okay, dispose of this asset, you have an exemption in the tax rate. So all these little things should be changed, but tax, really, I don't study this stuff. It's not my bread and butter. Anyway, so I'm glad I've showed you what are the features of on a broader measure of fiscal policy. What is a structural primary budget, cyclically adjusted budget, and the cyclically adjusted deficit, if you want to have a deficit or a surplus. So for example, a method to have a fiscal consolidation is, okay, I want to set all the macroeconomic variables for the fiscal policy so that I have a cyclically adjusted budget or deficit that gives me a surplus, so that I have a cyclically adjusted surplus, right? So if you run a cyclically adjusted surplus for a few fiscal year, then anybody should be able to see that the debt to GDP ratio, if the economy is growing, it should be decreasing. Okay, so that will change the fiscal position, and okay, I have the overall public purse has less public debt exposure. And the method to do this is having a cyclically adjusted surplus, or you have basically you want to have a strategy which is fiscal consolidation rather than having a inflationary fiscal position. So there are many things, and yes, then we saw what are the issues with the balance of payment. So there is a twin deficit in the balance of payment. Yeah, summary of balance of payments. So also is another drag on the GDP ratio. And yeah, so I hope you enjoyed this video. It's been very long, and I'll thank you all if you follow through. I hope that my explanation, my message to you has been understandable, not so boring, and yes, just type in a comment, thumbs up, like, and see you to the next video, and Merry Christmas, and smash it through the next year. Enjoy and have fun.